You just got a new job, good salary, first real paycheck, and the first thing your brain says is, get a better car. Makes sense, you earned it. So you walk into a dealership, pick something clean, sign some papers, and drive home feeling like you made it. But here's the thing nobody tells you before you sign. That car you just bought? It started costing you money the second you left the lot. Not just the payments, not just the gas, all of it. In ways most people never bother to calculate. We're talking about depreciation, interest traps, insurance spikes, and a sales process specifically engineered to make you feel like you're winning while the numbers quietly destroy you. Stick around, because by the end of this video, you'll know exactly how the new car trap works, what dealers don't want you to calculate, and what smarter moves actually look like. Let's get into it. Depreciation. Depreciation is just a fancy word for your car is worth less every day you own it. The moment you drive a new car off the lot, its market value drops. Not next year, not next month, that same day. Why? Because now it's used. A buyer can't get it factory fresh anymore, so they won't pay factory fresh prices. On average, a new car loses somewhere in the range of 15 to 20% of its value in the first year alone. By year 5, many cars are worth roughly half what you paid. Let's put real numbers on this. Say you buy a new car for $35,000. 5 years later, it might be worth $17,000 to $18,000. That's roughly $17,000 gone. Not spent on gas, not on repairs, just evaporated. Because time passed. That's the car equivalent of setting 3 $100 bills on fire every single month. And the wild part? You're paying this cost whether you notice it or not. It doesn't show up on a bill. There's no depreciation invoice. It just silently happens while you're busy making payments. But depreciation is only the beginning. Because soon, you'll find out what the loan structure does on top of that. By the end of this video, you'll see the full picture of why new cars hit harder than most people ever realize. Almost nobody buys a car with cash, which means almost everybody has a car loan. And car loans have a specific structure that most people never really look at. Here's how it works. When you take out a loan, early payments go mostly toward interest, not the actual car, interest. The principal, the real debt, barely moves at the start. This is called amortization. It's how basically all loans work, but it hits especially hard with cars because the car is also depreciating while you're barely paying down the debt. So in the first year or two, you owe close to what you borrowed, but the car is worth significantly less. That gap between what you owe and what the car is worth is called being underwater, or upside down on your loan. If you need to sell or total the car in year 1, you could owe thousands more than it's worth. Your insurance pays out current market value. The loan doesn't care about that. You're on the hook for the difference. This is also why dealers push something called gap insurance. It covers that gap if the car gets totaled. It sounds helpful, and sometimes it is, but mostly it exists because the loan structure creates a predictable problem, and they sell you the solution to it. Convenient. Here's the move dealerships love most. You sit down, they ask one question. What monthly payment works for you? Not what's the total price, not what's the interest rate, just what number can you live with every month? This is intentional. Once you're thinking in monthly payments, you stop thinking about the total cost. A $400 per month payment sounds manageable. But $400 a month for 72 months is $28,800 before you add interest. Stretch it to 84 months, 7 years, and the numbers get worse. You're paying interest on a car that's depreciating the whole time. You might finish paying for a car that's already falling apart. Dealers know that longer loan terms make payments look smaller, so they push them, and customers, focused on the monthly number, say yes. The monthly payment frame is basically a magic trick. It makes a $45,000 decision feel like a $500 decision. Let's actually do the math that most people skip. Take a $35,000 car. You put $3,000 down. You finance $32,000 at around 7% interest, which is in a realistic range depending on the market and your credit. Over 60 months, you're paying roughly $630 per month. Total paid, around $37,800. Add the down payment, $40,800. But the car might be worth $18,000 to $19,000 after 5 years. That's a real cost, money out of pocket minus remaining value, of somewhere around $21,000 to $23,000 over 5 years. And that's before insurance, new cars cost more to insure, registration fees, maintenance, yes, new cars still need oil changes, tires, and brakes. When you add it all up, owning a new mid-range car can run you somewhere between $700 and $1,000 plus per month in true total cost, even if your payment is $630. Most people only count the payment. Here's a piece of the puzzle most people miss. The sticker price profit? Often pretty slim on popular models. Dealers make serious money on the stuff around the car. Financing. If they arrange your loan, they earn a cut from the lender. The higher your interest rate, the more they make. They're incentivized to get you a slightly worse rate than you qualify for. Add-ons. Extended warranties, paint protection, fabric guard, window tinting, nitrogen in the tires. Most of these are high-margin products with real but overstated value. They get bundled in during the finance office visit when you're already mentally exhausted from the negotiation. Trade-ins. They buy your old car low, sell it high. The trade-in conversation often happens before the new car price is locked in, which means they can adjust one number to absorb the other. The dealership experience is designed as a sequence of decisions, each one wearing you down slightly for the next. By the time you're in the finance office, you're just signing. New car, nice car, expensive car. Insurance companies notice all three. Comprehensive and collision coverage, which you'll typically be required to carry if you have a loan, costs more on a newer, pricier vehicle, so your insurance bill goes up. And it stays up for as long as you're driving something new. This is another cost that lives outside the monthly payment number, invisible to most buyers until the first bill arrives. None of this means you should never own a car. Cars are often necessary. The point is to not let the feeling of a new car override the math of it. A few things that actually move the needle. Buy slightly used. A car that's 1 to 3 years old has already absorbed the steepest part of the depreciation curve. Someone else paid for those first brutal years. You get most of the same car for significantly less. Know your total cost, not your monthly payment. Before you sign anything, calculate. Total loan paid plus down payment minus estimated resale value in 5 years. That's what this car is actually costing you. Shop the loans separately. Get pre-approved by your bank or a credit union before you walk in. Then you're not dependent on the dealer's financing. You know your rate. You have leverage. Don't trade in at the dealership without checking. Private sale or services that give independent offers give you real market value. The dealership trade-in is almost never the best offer. Quick recap. Here's everything fast. New cars start losing value the moment you leave the lot. Early loan payments go mostly to interest, not the actual debt. Being underwater on a loan is a real, common risk. The monthly payment question is a frame designed to make you stop thinking about the total. Dealers make significant money on financing, add-ons, and trade-ins, not just the car. Insurance costs more on new vehicles. True monthly cost is often far higher than the loan payment alone. Buying slightly used lets someone else absorb the worst depreciation. Knowing your total cost and having your own financing changes the entire conversation. A car is one of the largest purchases most people make, and it's one of the only large purchases that's guaranteed to be worth less every single year. That doesn't make it a crime to buy new. It makes it a decision that deserves actual math, not vibes, not that new car smell, not what fits your monthly budget. The dealers are running numbers, you should too. If this video saved you from a bad deal, or made you feel better about a decision you already made, drop a like. Subscribe if you want to keep making better financial calls than your past self. And if you already bought the car, hey, now you know for next time.